Liquidity is one of the most important concepts in trading, and in this video I'm going to simplify liquidity into 3 steps. We're going to be talking about what is liquidity and the frameworks that I use behind liquidity. Then I'm going to give you guys my 2-step process to identifying and validating proper liquidity zones, and towards the end I'm going to give you guys a step-by-step trading plan in PDF, so you not only learn from this video but can also implement it into your own trading and hopefully pass your profit accounts and make your first $10,000 trading. But before we begin, make sure you guys take 2 seconds out of your day to smash that like button. It really helps. Thank you. Liquidity is the backbone of what drives the markets. It facilitates whether price is going to drive higher or lower. And the framework of liquidity is very simple. It's identifying the different swing points inside the markets, from a swing high to a swing low. A swing high and a swing low is a 3-candle formation, where the candle is in the middle is higher than a candle to its left and its right, or the candle at the bottom is lower than a candle to its left or the right. And when the market is in a trend where it's going lower and lower, it's going to report back below swing lows. And when the market is in a condition to where it's going higher and higher, it's going to report back to swing highs. We can see we're in a downtrend. Price comes back below this previous low. This is our level of liquidity until we drive down here, until there is no more liquidity. Now that there's no liquidity down here, the market is going to break higher and go from creating lower lows and lower highs to now creating higher highs and higher lows. As you can see, this is a strong low as price fails to take it out. Price fails to take it out once again. Instead, price breaks above this previous high, targeting back above old swing highs. Understand that the market will drive to wherever the most prominent areas of liquidity is. If there's no liquidity in a specific level, price is most likely going to see a reversal to take out opposing levels of liquidity. And the first way we can use liquidity is in the framework of a liquidity sweep. This is where price comes above or below an old high or low, takes it out swiftly before retracting in the opposing direction. Price comes lower here, sweeps this previous low, yet as we can see, price struggles to continue lower. This is what we meant in the previous example. This would classify as a liquidity sweep because price came down into this level, but it could not continue lower. Instead, it immediately goes in the opposing direction, creating higher lows. And as we get this break with strong displacement, breaking back above this previous high, this is solidifying that price has come lower. It has found a level of support, and now it's going to refer back to old highs inside the marketplace. So these lows now become strong lows, and these highs become weak highs. So price is going to give a retracement down here into this imbalance right here, find support to continue back higher into these weak highs right here and this weak high right here. It's understanding where is the weak points inside the marketplace and where is the strong points inside the marketplace. As price was going lower, every single low was a weak point until we reach a level to where price could not continue lower. Now every single high is a weak point up until we get back above this original high, which price swiftly take out. Another way we can use liquidity is as a draw. The main premise of liquidity is to be used as a magnet, where price will seek from liquidity pool to liquidity pool. Price comes higher, sweeps this area of liquidity, but as you can see, it struggles, giving this rejection up until we get this displacement down here, followed by this break of structure. So this is our classification that price came higher, could not continue any higher, and now the weak points inside the marketplace is this old low followed by this old low. So price comes back into this last up close candle, which is our bearish order block, finds a level of resistance to then see lower prices. Now after coming lower, taking out these previous lows, there's no more liquidity down here. So price is going to break higher, finding support inside of this bullish imbalance in the framework of this fair value gap, which is higher from that fair value gap, comes back down into that fair value gap once again. Now our weak points of liquidity is now higher prices. So this old high is our liquidity pool, as well as this old high right here. Price comes higher, takes out that old high perfectly. Then after immediately taking out that old high, we get this reversal back lower. This reversal back lower, you can frame your first trade entry right here inside of this inversion fair value gap, reaching back below where? Old lows, right? This will now classify as a weak low. Because price came higher, swept a level of liquidity, followed by this break lower, this is our weak low. And then price comes back higher into this inversion fair value gap up here to then reach back below lower prices. And this is classified as our strong high because this is the previous high followed by this break lower. The premise of the marketplace is to seek from liquidity pool to liquidity pool. You don't need a million different indicators. The 2 things that we used in this entire example were simply where is our drawn liquidity and using fair value gaps to get there. We use this fair value gap after price swept this liquidity. Now we're targeting back up here. Then we use these inversion fair value gaps to reach back below lower prices, keeping things very simple. And if you guys want access to the full PDF, I will be putting it inside of the PDF section in our free Discord. Inside of this free Discord, you guys get access to my brother's free 4-hour course, as well as my free 2-hour course. Inside of this free Discord, you guys do get access to daily live analysis and trade breakdowns from me and my brother, as well as a community of traders looking to get better, sharing their trades, looking to learn from fellow students just like you, of me and my brother. If you guys want to join the completely free, that's going to be a first link description. Looking at a blank chart, this could be a little confusing. Let's fix that. An indicator that I like to use is the ICT Sessions Kill Zones by Leon Shallow. This marks out all of the sessions throughout the trading day, so you understand where we're at. These are the specific times that I use for this indicator. London session between 2 to 5, New York between 7 to 11, Asia session between 8 p.m. to midnight, and London close between 11 to 4 p.m. Using this indicator really helps you when it comes to identifying what session are you in and what has the previous session done. So we're currently coming into the New York session between 7 to 11 a.m. Eastern Standard Time, and we can identify this previous London session high, as well as we do have these previous London session lows. It's very important to mark out your previous session highs as well as your previous session lows, as these are very important levels inside of the market. When framing a bias, I'm thinking of one or two things. If we can see price come up higher into these previous session highs and then give a level of rejection, we can then frame a short reaching back below lower prices. But we also have this bullish fair value gap open up, come down into this bullish fair value gap, find support, we can reach back above into these London session highs. There's multiple ways that you can trade the markets. Don't ever think that it's just one-sided higher or lower prices. This is what trading is all about, keeping things very simple and opening up different opportunities for different scenarios that could happen. You can see 7 a.m. opens up, price comes down into this bullish fair value gap, finds a level of support to push higher. If you were in this position to where you were trading the New York Open at 7 a.m. when price came down into this fair value gap, you could frame this long reaching back above these highs. Putting your stop loss back below this fair value gap low, this would have yielded you about a 2.6R. After price comes higher to take out this level of liquidity, do not chase the markets, because price could easily reverse from this level. Instead, be patient and see what happens next. We can see price immediately drops to the downside after sweeping this prior liquidity. Now, once it comes back into this bullish fair value gap, I want to see, is price going to hover around this level to maybe offer its support for a continuation higher? Maybe take out this previous high, or is price going to break back below this level to see a continuation back lower? This is called if then scenarios. If this happens, then I'm going to do that. It exercises patience and waits for the right opportunity to strike, breaking back below this bullish fair value gap. This is an indication that price had found a level of resistance after sweeping these prior London session highs. Sellers now control the markets, so we can anticipate a continuation back lower from the sellers to take out levels of sell side liquidity, which is these old lows. As price closes below this inversion fair value gap, I'm going to place my stop loss just back above this previous 15-minute high, reaching back below these lower prices here for about a 2 to 1R. As price creates this inversion fair value gap, breaking back below this level of support, which now turns into a resistance, we can use it as an opportunity to now target opposing levels of liquidity. And we can see price comes lower, tapping into our take profit, reaching back below lower prices. Trading can be very simple if you allow it to be. The more that you try to overcomplicate it, the harder it will become. So we're coming into another day here, and we're looking at the London session. And to the left of us, this is the Asia session high and low. So if we can see price come back above this Asia session high, giving a level of rejection, maybe we could see a drop lower, reaching back below into these Asia session lows. Or we could see maybe price would come lower, tapping into these Asia session lows. If we could get some type of rejection here, we could frame along, reaching back into these Asia session highs, going from liquidity pool to liquidity pool. Price comes lower, sweeping these previous Asia session lows, and then we had this break above higher. Price broke above this bearish fair value gap, and this now becomes an inversion. What I could do here is I could frame my entry as price broke above this bearish fair value gap here, closing above it, adjusting my stop loss just back below these Asia session lows, reaching back up into these Asia session highs for a 2 to 1R. This model is referred to as the inversion fair value gap model, and it works in all markets. Price opens up, comes back into the high of that inversion fair value gap, seeing this break back higher, And what we can see here is price then creates this bullish for value gap. As price comes back into this bullish for value gap, I can add another contract, adjusting my stop loss just back below these lows, putting my original trade back at break even, reaching back above these highs, turning this trade from a 2 to 1 hour to now a potential 3 to 1 hour. I wouldn't recommend scaling into a beginner trader, but for someone who's trading a lot longer, when you have confidence behind your model or a particular setup, it's very good to add to your winning positions, maximizing that reward. Price comes lower, taps us in. We can see price continuing back above higher and higher prices, just like so. So if you weren't able to get your trade down here at this inversion fair value gap, don't worry. Price will offer multiple opportunities throughout the trading day, so you never have to feel FOMO. That's going to be it. I hope you guys enjoyed and got a lot of value from this video. If you guys want access to today's PDF, as well as my free course and my brother's free course, that's going to be a first link description to join the Spark Train community. So before you leave, make sure you guys click that like button, subscribe if you haven't already, and leave a comment of what you guys want to see next. I'm Arkham, your new mentor. Be safe.